All right, so welcome to tonight's webinar. Tonight we're going to be talking about a couple different things, but the main thing I want to talk about is knowing when to be more aggressive when it comes to taking profits or to be much more conservative when it comes to taking profits. And I have two examples of how I want to break that down for you all. I think this is going to be a very beneficial webinar, especially given our current market situation, given all that's happened. We've had a lot of craziness in the markets recently. We've had low floaters making 1,000% moves. It's been insane. I'm going to talk about that a little bit as well. And I want to mention how we can best take advantage of those moves while still being safe, while knowing when to be aggressive on those low floaters and knowing when to be more conservative. So before I dive into that, I just want to mention real quick that we are doing a little bit of a discount here. If you sign up before July 21st, you will receive $50 off your first month. So this is for everyone who's on a free trial. You will get $50 off your first month if you sign up before July 21st. We very rarely do any specials like this, but we wanted to do something for all of our free trials. Again, it's pretty rare we do specials like this, so be sure to take advantage of that. And then, of course, we do still offer the free 2-week trial for everyone. Just head to kfinvesting.com and you can get signed up there. So let's go ahead and get started. One more thing. I just want to talk about the Las Vegas retreat, which is coming up in less than a month. I am ecstatic to meet all of you. We have a whole bunch of people coming. I'm so excited. It's going to be an incredible event. If you have questions about that, feel free to message me or any of the moderators or anything like that. It's going to be a blast. We'll be trading together, seminars all throughout the day. It's just going to be incredible. It's going to be truly incredible. It's going to be great to meet and get together with all the KAF family. So if you are interested, definitely still availability, so please let us know. Now, I always love to start these webinars off talking about current market health, because understanding the current market health is going to give us a perspective of what kind of biases and what kind of mindset do we want to have as we approach our trading day. So let's just go ahead and talk about the Dow Jones. Okay, the Dow Jones Industrial Average is one of the main indexes used to gauge market strength. Now, the Dow Jones, this chart I have here is the Dow Jones over the last 3 years. Okay, and now you'll see some red lines on there. I'll talk about that in a second. But as you can see, over the last 3 years, the Dow Jones has really had some incredible strength to it. It's nearly doubled. It's up, almost about 70% or so over the last 3 years. That's incredible. If you invested $10,000 into the stock market 3 years ago, you'd have roughly $17,000 now, give or take, more or less. But it's incredible. So we see this overall trend over the last 3 years from the markets making these pushes upwards. Now, notice those red lines I have there. I want to talk about these red lines because I want to talk about something known as channeling. Okay. Now, yes, we're looking at an index, but this term that I'm about to talk about, channeling, is something that will apply to all stocks, be it penny stocks, blue chip stocks, mid-cap stocks, OTC stocks, anything. It's going to apply to all stocks. And that's the case with all of stock trading, really. Any patterns you're talking about can be applied to all different levels. That's what's so great about it. I love that it's a very universal industry. Now, what do I mean by channeling? Channeling is when we get a stock, or in this case, the overall market, we get the index to trade within a certain area for an extended period of time. Now, on the bottom left of the chart there, you will see those two red lines, and you'll see that the markets went sideways here for, this was about a year or so. This was just before Trump was put into office, and you'll see the markets really went sideways here for quite a while. Now, it's really important to understand what happens when we either get a break out to the upside from a channel or a breakdown to the downside of a channel. That's going to signal a new trend. So a channel, when you get a stock that's channeling, it's not a trend. It's not necessarily trending. We call it sideways movement. We'll say it's flat. We'll say it's channeling. There's 100 different words or ways you could put it, but they all mean the same. It means that there's really no upward or downward trend from the markets at that time, and it's simply moving sideways. Now, what you want to look out for is if you're intending to go long when a stock or an equity or whatever it is, in this case an index, breaks above that channel. That's a very bullish sign that you want to start going long. Now, if the markets would have broken below this channel here, as we see here, let me draw a little bit here. Had the markets, instead of pushed up here, had they have moved below this channel further downwards and broken below this support line, then that would be a sign to start getting a short bias, okay? Now, why do I bring all this up? I bring all this up because look what we are currently experiencing here from the overall markets. Oops, sorry about that. I'm messing everything up. Look what we are currently experiencing here from the overall markets. We are getting some channeling, okay? And this is very similar to the channeling that we saw about 2 years ago here in this area, okay? So the markets are going to be making some decisions in the relatively near-term future. That's another thing about when stocks or the indexes or anything channels, it doesn't happen forever. I promise you that when something is channeling, it usually leads to a pretty significant move either to the upside or to the downside. All right, so in this case, if history repeats itself and we get a break up above this channel here, then the markets are in for another step higher. Now, if we see the markets break below this level here, then that would be a very bearish trend. So again, this is channeling. This can be applied to all different stocks. Now, I want to explain for a second here. Let's look at the Dow here on a shorter term chart. So we were just looking at the Dow from a 3-year chart. Now we're taking a look at the Dow Jones Industrial Average from a 6-month chart. Now this looks a lot different. Okay, this doesn't look as bullish. Let me go back to the other slide again. When you look at the Dow like this, wow, it just looks so bullish. Pretty, overall a pretty solid uptrend here. Yes, there is some channeling here, and there was obviously some channeling here, but everything looks pretty good for an overall upward bull trend, right? Well, as we look at this on a different scale, a little bit shorter term scale, like this here on the 6 months, things look a little bit different. We still have this channeling here. This is the channeling that we previously talked about. But when you consider that this is quite a ways off of its highs, and it's trading what I like to call mid-range, it kind of makes you question a little bit more the overall market strength. Now, let's see here. Well, that's a great question, Rob. Thanks for asking that. I missed that question. He's asking, why do I look at the Dow and not the S&P? Well, the truth is, you can look at any of them. They will all very similarly resemble and reflect the overall market health. But for my preference, I typically like to watch the Dow mainly. Now, I wish I had a scientific backing for that, but in my opinion, the Dow Jones, it has a wider variety. It's a broad index. It has I wish I had a better answer for you. After this webinar, I'll dig a little bit more into why I like watching the Dow a bit more. But the truth is, you can look at all of them. The Dow, the NASDAQ, the S&P would all look pretty similar. Now, the NASDAQ, the reason why I don't look at the NASDAQ as much is because that tends to be weighted a little bit more heavily in favor of tech stocks. So, for example, the NASDAQ was actually trading at all-time highs 2 weeks ago, whereas the Dow and the S&P are quite a ways off of its highs. So that can be a little bit deceiving from the NASDAQ because the NASDAQ will represent, the tech sector. If it's being really hot, it can make you, give you a little bit of a skewed vision of the overall market. That's a great question. Really, the Dow or the S&P should give you, a really good idea of what we want to look at here. But when it comes down to it, I just pick the Dow Jones just for whatever preference. So moving forward here, Knight's asking, what is the Dow ticker symbol again for anyone that might not know? So this is what you're going to want to type in here, DJX, okay, /DJX. That will give you your Dow there, okay. All right, so let's go ahead and move forward here. Again, on the 6-month chart, we're seeing the channeling, but I want to break this down a little bit more, okay? The Dow is trading very mid-range. What do I mean by mid-range? I mean it's about halfway up. It's about right in the middle of its highs and its 6 months lows. If something's mid-range, it means just trading in between recent highs and recent lows here. In this case, 6 months. So I don't like trading stocks that are mid-range. I always want to wait till they break out to the upside or break down to the downside. I just never want to buy a stock that's mid-range. Now, I will dip buy stocks, but that's different than buying a stock mid-range. And if you trade with me in the chat room, you'll start to see and understand why. And potentially that's a subject, for a different webinar, the difference of buying mid-range and the difference of, dip buying a stock, which has a good bullish uptrend. But anyways, my point I'm trying to make here is, though, look at these points. We are slowly but surely getting higher lows. You see here, pretty similar lows. Here we have higher lows. Here, we're off a little bit from those lows, but overall, we do have a little bit of a curling action here from the overall market. So I am still bullish here in this market. I'm not going to throw out all of my long plays and only short by any means. I still am leaning towards being bullish, but in terms of channeling, we are dead in the middle of this channel. In fact, we actually might be even closer to the bottom of the channel than we are to the top of the channel. So this is something, please start to look for channels and look for the breakouts above the channels. Now you could also consider this the top of the channel, but because we have many more resistance points here, to me this is still the breakout level. This is a 3-point resistance level, and I'm going to talk a little bit more about 3-point, 1-point, 2-point resistance levels as well here in a second. Notice DC just sent out in the Discord app the NASDAQ and how different that chart looks. You know, the NASDAQ is very different because it's just weighted differently. It's considering other factors. The NASDAQ chart, like I said, was trading at all-time highs just 2 weeks ago. All right, so let's go ahead and move forward here. I want to talk about the overall market health again. I'm still bullish on the overall market, but if we do get a break below that bottom trend line, then we'll want to reconsider things. So now I want to talk about sector strength. Okay, the market makes runs in sectors. I was just talking about the NASDAQ and how tech stocks were pushing the NASDAQ to trade at all-time highs only 2 weeks ago. Well, that's because that sector, those tech stocks, Amazon, Google, Microsoft, all of these things were just screaming. Netflix, I mean, just all those big plays were screaming to new highs, you know, day after day after day, and that was pushing the NASDAQ higher and higher. So that sector, the tech sector, was really hot. You could be really aggressive trading those tech stocks that were in the tech sector, and I was. I traded SQ, I traded Amazon, Netflix. I traded those real aggressively because the sector was so hot that I knew that the overall push would be to the upside. Now, the most recent sector that's been really hot, as everyone I'm sure knows, is the energy sector. These are the plays of these stocks have literally been making 1,000% moves within 2 days. And this was, you know, early this week and last week. It's just been insane. Anything that it seems to be an energy stock has just been going nuts. These are oil and gas companies. There's a wide variety of solar companies, everything. These stocks have been going crazy. Now, we've traded all of these. We've traded all these, and I've won on all these except GBR. GBR I bought about right here at 350. I got stopped out. Well, yeah, it ended up hitting nearly $20 later. So I actually lost on GBR. I won on all these other ones. But the point is, this sector is just insanely strong. Now, how does that apply? I just want to talk about why knowing what sector is hot can apply to our personal trading. Here's why. Today we had an incredible trade on A&W. Okay, well, let's think about what A&W is. The A&W is an energy play. It's a low flow energy play, just like these other stocks. Okay, look at these insane moves these stocks have been moving. A&W is just the same. Now, A&W released some positive news, and so we were all over it. You know, our moderator channel was all over it from early. I was a little bit more patient, a little bit safer. I wanted it to break over some certain levels, but the point is there was a ton of money to be made here. And I want to break this down even closer here and explain why I was aggressive trading A&W compared to my other trade, Facebook. Okay, I traded Facebook and A&W. Now, these are two very different stocks. Okay, that's the first thing to understand. Facebook is a blue chip stock trading at almost $200 a share. A&W is a very low float stock trading at, you know, it was under $1 before today. Okay, they're very different stocks, but I still want to explain to you why I was really aggressive with A&W, letting it move as much as it did. And whereas Facebook, I didn't want to take any risk. I was really tight on how I traded Facebook, and I want to explain why. Now, first of all, it's important to understand with Facebook, I was trading a lot more money than I was A&W. So a 0.2% move from Facebook, you know, that may seem like absolutely nothing, but it was actually, you know, really solid profits for me because I traded it with much higher amounts of capital. And if you're in the chat room with us, of course, you'll understand, you know, that's when I'm talking about sizing, 1x, 2x, 3x, 4x. Understanding what position size to use in different plays is so important. So anyways, these were two trades today. A&W, I took almost 20% off this trade. I'm going to break that down. Whereas Facebook, I only took 45 cents, you know, from a $200 stock, 0.2%. I want to explain why I was so aggressive with A&W and why I traded Facebook like a scaredy cat. So here's A&W, okay? Remember a second ago I mentioned this idea of 3-point resistance. What is 3-point resistance? Well, 3-point resistance, as I've illustrated here, is when you get a level that the stock gets denied at multiple times. We call this 3-point resistance. See these highlighted areas here? These are all points of resistance that the stock got denied at, okay? So, you know, if had this have gotten denied 2 more times, had this stock come back up here like this and gotten denied again, well, that'd be 4-point resistance. You know, there'd be 4 points of resistance that it got denied at there. The more points of resistance you have, the better the breakout will be, historically speaking. Okay, so if I'm looking at a stock that has a 5-point resistance at $2 versus a stock that has a 2-point resistance at $2, I'm going to lean towards taking the breakout on the 5-point resistance stock, because the harder that it has been held down and the more points of resistance it has, the more buyers are sitting right on the other side of that resistance level to ride that up once it finally breaks. Now, obviously, there's no such thing as a sure thing, okay? Our job as traders is to take what historically has worked the best, and then we try to replicate that. And we adapt as, every day we make new history, right? Tomorrow hasn't come yet. Today's happened. Well, today's trading day is now history. So we can look at today's history of the stock market and see what worked, and we can replicate that moving forward. So when I say we look at history, I'm not saying we're going to look at, things from the 1990s, although those will apply, having said that. But more recently, we need to look at what happened today, what happened yesterday, what happened last week. And those are the types of patterns, just like these energy plays. These energy plays all last week have been insanely hot. Well, when we played A&W today, all we were doing was looking to repeat history, take advantage of those moves from these energy plays. So there's no, nothing's perfect. Even though we see history, it might have worked 99 out of 100 times in the past, and we could play it in the future, and it's possible it doesn't work. That's just how it works. That's why we always have. That's why we always have. Chances are we're going to win more trades than we lose because we're good traders. We have good moderators. I'm a good trader. I don't mean to toot my own horn, but I'm a good trader. I do this for a living. I've proven it time and time again. So that's why you just want to play the percentages, play what works best. We're not gambling out here in the stock market. Okay, enough of that rant. I'm sorry. Let's get back to A&W here. So here, this was a 3-point level of resistance. Now, before I alerted this stock, I was actually talking with Channing, our moderator, and we were debating playing it over 170. We were talking when the stock was right here. Me and Channing were saying, okay, we really like A&W for a trade here. Let's decide where we want to take it over. Now, we were considering playing it over 170. Do you see this denial right here? The stock got denied there at 170. Let me clear that up a little bit. The stock got denied here at 170, and once the stock got denied at 170, I told Channing, I said, look, if this gets denied one more time at 170 and pulls back again and makes it a 2-point level of resistance, then I'm going to go ahead and take it over 170. But it didn't. The second time it came through, it broke right through it. And so I then wanted to be safer, and we decided we would take it over 180 because it was a safer play, and it was a 3-point level of resistance. And look at the follow through we got. Now, this broke from 180 and hit the 193 area within maybe 15, 20 minutes or so. This is where we bought right here, and it ended up hitting 193 here within 15 minutes. Now, that's great profits, and we actually had some members take profits, and that's fantastic. That's incredible. I'm so happy that they took profits because they're understanding that we want to take profits as we get them, right? But why did I not take profits? Why was I a little bit more patient on this? Well, just like I said, just like how I was trading Amazon and Netflix super aggressively, last month because tech stocks were on fire. Well, with all that we've been seeing from these energy plays, I knew that I could be a little bit more aggressive. So the stock actually pulled down below my buying point. You'll see this dip right here. It actually pulled down below my buying point, and I was actually losing on the trade for a minute. And I wasn't real worried. I had my stop loss at 164, which is about right here, the 164 level. And I wasn't real worried. Now, I knew that, of course, there was a possibility the stock would fall under and hit my stop, and I'd be out. But that's okay. I'd move on. I'd be ready for the next trade. But in this case, I had a lot of faith in this sector. These energy players have just been so hot. And look at the absolute rip that we got here. I ended up taking profits in after hours at 214, about right here. But I actually rebought in at 231. And I'm going to explain why I rebought in at 231. But this hopefully explains why I was so aggressive with A&W. Why did I not take profit after it moved from 180 to 190? That's 10 cents a share on a $1.80 stock. That's incredible. Why did I not take profits? Because I knew I could be a little bit more aggressive with this sector. Okay, the sector was behind me, and I knew I could play it. Now let's talk about Facebook for a second, and this is the exact opposite. Again, I traded this like a total scaredy cat, and I want to explain why. Let me clear my drawings here. So this is Facebook here. Oh no, I have the wrong chart. Oh no. It's okay, I have it. Let me see. Yeah, I posted it twice, huh? It's okay, I have it again right here. Okay, so this is Facebook here on the left side. Ignore this over here for a second, okay? No one's allowed to look at this for a second. I'm going to talk about this in a second. But this is Facebook here over on the left side. Same thing, same setup, exact same setup as A&W. Look at this 3-point level of resistance at 195.50. Got denied here. This was back on Tuesday, and then got denied here in pre-market, and then this was market open today. Right here was market open today. Now I bought this over 195.50. I bought this over this 3-point level of resistance. Now I said my price target was going to be 196.50, 197 area. Okay, which is about right here. Now it got really close. It almost hit my price target. But having said that, I ended up taking profit on this real early at 195.94. Okay, right here. Now let me explain why. Tech stocks have not been as hot recently. They've still been fine, but they haven't been as hot. It's by no means an A&W, right? You know, that sector just hasn't been as crazy like the energy plays have. Now, in addition to that, in addition to this sector not being quite as hot, I want to talk about the role the overall markets play in this decision. So let me clear things up. Now, do you see this gray shaded area here? This gray shaded area is the exact time frame of the Dow Jones over here. Do you see that they're both shaded? Let me explain that again. The beginning of this gray shaded area is market open this morning at 7:30, okay? Beginning of this gray shade area is market open at 7:30, and then it goes to about 9:15. Oh, sorry, this is Mountain Time. I'm on Mountain Time, so this would actually be 9:30 a.m. But this is 7:30 Mountain Time, so 9:30 a.m. to 11:50 a.m. Well, this is also the Dow between those time periods. This is the Dow Jones from market open to, you know, about 2 hours or so into it. Okay, this represents the exact same time frame. Now, I want to talk about here how the overall markets were scaring me. I saw this, let me see. I'm trying to think real quick. Let me match these up. Yeah, okay, so I bought Facebook here over 195.50, and we got a nice push up about 10, 15 minutes or so into market open. Well, that was in sync with about this time. I sold Facebook right when I saw this. You see these candles right here? These red candles scared me. They scared me badly. You know what? Actually, I believe it was these two candles. Now that I think about it, it was actually these two candles that I sold at, and then they scared me because I know that Facebook's going to follow the overall market so carefully. So as soon as I saw these red candles forming, I jumped out. I took 45 cents a share. Now you'll see this ended up actually continuing a little bit, but ultimately the overall downtrend in the market took over. And look what happened to Facebook. Facebook did the exact same thing. It followed that. So with Facebook, I just knew that I couldn't be as aggressive because I knew it was going to follow the overall market. And the trade wars, the talks, everything's just been crazy. We actually had a gap up from the overall futures this morning, but I was worried that you know, also we had job reports came out this morning, and that worried me a bit this morning as well. So there are a lot of different factors that went into me being a total scaredy cat on Facebook. So I took my profits real quickly. We still got a great breakout over 3-point resistance levels. You know, we still got nearly $1 move that I could sell into and take profits on. But we by no means got that move that we did from A&W this morning. And I hope that explains a little bit why I was aggressive with A&W, why I was not aggressive with Facebook. Now, Facebook ended up making a pretty significant move later on in the day. You know, as you can see, right? This ended up making a huge move, and it was solid, and it was great. But having said that, I would have been stopped out. I would have been stopped out probably about right here, you know, and I would have ended up missing this whole move because you always have to gauge your risk. You can't. I don't like to just hold and hope just forever on these things. I want to gauge my risk consistently so that every day I can show up to the market, I can pull profits out, I can gauge my risk. I mean, it's my job. That's what I do. You know, people go work 8 to 5s. Well, this is what I do. You know, this is my job. I show up. My job is to pull money out of the markets on a daily basis. It's how I eat. It's how, you know, I buy my wife nice gifts for our anniversary, right? Like, it's my well-being, okay? So this is not an emotional experience for me. Instead, this is a statistical experience for me, right? I'm just trying to play my odds, take my best chances. Just like you know, when you're driving on the freeway, you usually are going to get in the lane that you think is going to give you the best chances to get where you're going the fastest, right? Now, once you have emotions and once you get road rage, it kind of skews that decision because so-and-so cut you off and now you're mad. Now you're switching lanes back and forth and who knows what's happening. But if you can stay consistent, emotionally stable, view this, you know, this is a job. It is a job. Now, it's a fun job. We're lucky. We have insane amounts of freedom by doing this. We're totally lucky. but we have to keep emotion out of it. I don't like to just hold and hope blindly. I like to have a plan. I like to stick with that plan because I know that plan will pay me on a daily basis. I'm going to get a paycheck daily. And additionally, I just love it. I just love what I do. So anyways, so that kind of sums up. Hopefully that answers why I wanted to be aggressive on A&W, why I didn't want to be aggressive on Facebook. Again, I know they're two completely different stocks. I know, okay? They're totally different, but the principles are the same there. Let me just go to the last slide here. That is all I have for tonight. Thank you for joining me for this webinar tonight. Do you guys have any questions before I hop off here? I'd be happy to take some questions here. Let's see if we get any questions coming in. I hope this was helpful explaining why I was okay with it being aggressive. It's so important to know what sectors are running hot. Right now it's the energy sector. Tomorrow we could wake up and it could be cancer biotech stocks, or the next week it could be anti-opioid addiction drugs. It could be anything. The sectors are constantly changing. That's one great thing about having a team like we do, is that we can be prepared for all the changes in the sectors. So I'm not getting any questions here. So I think we're just going to keep it nice, short, and succinct. I love keeping these webinars succinct here. Oh, Knight's asking a question. How do you know which sector? Well, Knight, last week, all those stocks were going insane. CEI, PED, GBR. So all we have to do is look and say, wow, this stock made a 1,000% move today. What sector is this in? Oh, it's an oil and gas company. Okay, interesting. I'm going to keep my eye out for oil and gas companies. Or maybe next week, someone's going to release positive data, like I said, on a cancer drug. And then it makes a 1,000% move again. Okay, well, let's start looking for cancer-related biotechs that are releasing positive news, because those will be huge. Those are sympathy plays. They run with each other. You would be amazed at how one stock moving off of positive data will make another stock who's trying to basically build the same drug move in the exact same way. Mike's asking, is that one of the criteria for determining if it's an A+ trade or not? Let me see here. Sorry. A+ trade or not, which sector is hot? It definitely plays a role in it. It's not the only criteria, but as I've mentioned before, there's technical trading and there's momentum trading. I like to be a mix of both. So I love to take technical breakouts like the 3-point levels of resistance that I mentioned on A&W. Let me show you again. These 3-point levels of resistance. This is a great technical breakout. But there's also a momentum aspect to it, right? The fact that the sector was hot, that's an addition. That's a momentum aspect. It's kind of like a cherry on top type thing. It makes it an A++ setup. The technical breakout, yes, it's an A+ setup, but the moment when you include the momentum aspect to it, it makes it even better. One other thing I want to talk about. Oh, let me answer this Steve Ski question real quick. How do you determine which stocks are trading on their own and not following the overall market? That's a good question. Okay, so for beginners, when you get a stock trading well above what I call relative volume, it's not going to pay much attention to the stock market, overall markets. And here's the example. This is A&W. It traded A&W. It traded, I think, 40 million shares today. Okay, on average, it trades like, I don't know, 2-3 million. I can't remember. So this was trading almost 10, 20 times more than it usually trades. Well, when a stock is trading at insanely high amounts of what I call relative volume, and I call it relative volume because we're just paying attention to how today's volume compares to its historical average volume. So it's relatively higher. So A&W 40 million shares, that's a lot, all right, compared to what it's historically trading at, what it's relatively trading at. And so when you get a stock that's just trading at insane amounts of volume, you can basically just know that it's not going to be following the market. It's going to do whatever it wants to do. It's going to be its own person at that point. It's like the parents gave it the keys to the car. Here's all this volume, all this gas in the tank. Go ahead, do whatever you want. To the upside or downside. It goes both ways. It's not always to the upside. Lots of volume can mean it can be volatile to the downside as well. One thing I want to talk about real quick. Someone asked me today why. I alerted my price target at 210. I said I'm buying over 180. My price target's 210, which is right here. Someone asked me why was that my price target? How did I come up with that number? Did I just pull it out of who knows where? Well, here's why this was my price target. First of all, I want to consider the range that the stock has had, okay? This stock opened up at 60 cents down here, okay? 60 cents, that's insane. And at this point, it hit highs of $2, okay? That's crazy. So consider the range. That's a $1.40 range, or, over 200% roughly of range, okay? This is what we call the range. A range means how much a stock has moved. Okay, so we know that this stock has some serious range. Now, in addition to that, we saw that continue to be true from the pullback from $2 all the way to $1.10. It pulled up here, $1.50. I mean, this thing was just making these massive swings. So I knew I didn't want to play this short. I knew I didn't want to play this for 6 cents because look at the range that this stock has. Now, additionally, I made my stop loss lower at 164 because I knew that this might need some room as well because of that range. I knew that this might need some wiggle room. And that's why I gave the stop loss here at 164. Because these stocks that have range, they're crazy. You know, they need more room to move. You know, these are making 20-cent jumps over the course of a couple minutes, you know, 15, 20, 30% jumps over the course of a couple minutes. And so if you're playing these stocks, you also want to take that into consideration and oftentimes take smaller size so that you can, you know, kind of wait out some of the range. Now, you always want to have a plan, you always want to have stop loss, but that stop loss, you'll typically want to give it a little bit more room in situations like that. So anyways, my price target was 210 because it had insane range. You know, 30 cents from this stock. I knew if this could break over 180 and retest the high of day at $2, I knew we'd be in for a lot of fun if we get that $2 break, and we did. And so I sold them to pop over $2 at 210, and it's hit 240. So I mean, there was plenty left on the table here. I often say my biggest weakness as a trader is sometimes I'm not patient enough. And in this case, when this sector was as hot as it was, when the stock was as hot as it was, trading with such high relative volume, you know, of course, it's easy to say now, oh, I should have been more aggressive. Oh, why didn't I sell at 240 today, right? But remember, our goal is not to buy at the exact bottom, and it's not to buy at the exact top. In fact, if you find yourself buying at the exact bottom and selling at the exact top, one, you're the luckiest person in the world. Two, you're being too aggressive. You need to be a little bit more conservative because you're just getting lucky with those. Now, if you do sell into strength, like I often mention, if you sell into the strength while the stock is moving upwards, sometimes you will get lucky and actually sell at the top because you're selling into strength. That will happen sometimes. So. All right, I've babbled quite a bit here. Are there any other questions here before I hop off? Thanks for joining us tonight. Remember that our special we're doing here. We are doing. Oh, let me erase all this. Sorry. We are doing. If you are on a free trial, your first month is $50 off. If you sign up before July 21st. Let me get all the way back here. There it is. Yeah, so it is $50 off if you sign up for July 21st. This is, obviously it's 2019 now. Or sorry, 2018. July 1st, 2018. So, all right, I'm going to hop off here, guys. Thanks for joining us. It's been great trading with you all, as always, and I'm looking forward to another incredible day tomorrow. I am going to hop off.